Hi guys, this is Dara. First off, apologies for my absence. Yeah, I took a very long absence from the educational side of informative and educational part of trading. It last year really drained me a lot, and I had to take off time to do a whole lot of things that I've kept pending, right? But we are back, right? So also, apologies for the rebranding of my name, and I know that has made a whole lot of people not even recognize that I'm still the one behind this YouTube channel, right? A whole lot has been going on with the brand, with my brand specifically. My accounts have been banned consistently over a couple of times on TikTok, on Instagram, and that's basically where I stay, TikTok and Instagram. So my account has been banned a whole lot of times. And, I'm also human to some extent. It gets frustrating. And I just, you know what, let's just let it go. Right. So, but I'm back now. Yeah. Although my main focus now is on Twitter and then Instagram. So we went from Chidera Trades because it seems that name is attracting a whole lot of heat for some reason. I don't know why. So we went from that to Dera Portfolio, and the name of our Forex trading brand, our academy, is the Portfolio University, and hopefully we're not going to be changing it for a very long time. Yeah. So in case you're listening to this video, hi again, it's Shidara Trade. So for me personally, I'm just going to be doing this in some sort of journaling way, public journal. I'm not going to be editing, creating an aesthetically pleasing video, right, for your engagement and consumption. I'm just going to be putting it out there raw and as factual as I can be, like I usually do. I don't really have time to do a video of 30 or 1 hour long and then start scripting, editing, adding pop sounds. No, no, no. If that's what you're here for, then there's a whole lot of YouTube channels that are willing to do that. But for me personally, you just get the real facts here, and you guys know all I give is value. So now that we've gotten that out of the way, I'm gonna be doing a series. It's not a promise, but I will try to keep up. I'm gonna be doing a series where every little thing that I use in trading that usually helps me out, I'll be doing like a mini Sunday kind of videos, and I'll be posting on my YouTube. So do well to subscribe if you are watching this video now. And also, if you feel like I'm speaking too slow, I want to take my time to articulate my words. But if you feel like I'm speaking too slow, just use the speed button. It should be somewhere around your settings on YouTube. Just click on it, put it on 1.25 or something. That way I'll be fast and you can also hear me clearly without me mumbling. So today we're going to talk about candlestick anatomy, and I've thought about it carefully. I've done a couple of space on Twitter. All right. I've been hosted on a couple of space and I've spoke about it, and I had a lot of questions in my DM. Right. Some people understood, some people really didn't understood. And I will tell you for a fact, this is something that is not an active knowledge that you need to practice. It's something that is passive, but then again, it is the beginning of everything you do. It is not stuck to a strategy. Okay. So I will try as much as I can to be teaching things that are not specifically niched down on a strategy, unless it's my strategy, right? I'm just going to give you guys the info, and then you can find a way to apply it to whatever you're trading. However you're trading it is totally fine. At the end of the day, profitability is the goal, yeah, and true profitability, not the shenanigans that goes on online, right? So let's talk about candlestick anatomy. So what is a candlestick here? I made a tweet earlier when I was talking about this thing. A candlestick is simply, in a simple fact, it's a graphical representation of the numbers in fundamental and finance. All right, so it's like a graphical representation of numbers of economy. All right, so let's take an example. I know so many people, when they want to do example, they use USA, but I'm not going to use USA. Let's use Nigeria because that's where we are from. Yeah, let's be proud of our country for once, even though it's going to shit. Yeah, so let's use Nigeria for an example, right? And we are talking about the price of fuel. And this is something everybody can acknowledge. Fuel is going up and down every day. Like, I don't know. So let's talk about the price of fuel. Now, let's say from 2016 to 2022. Okay, so let's say to 2025, right? The price of fuel has been fluctuating. Right, it went from 600, if I'm correct, I think 400, 300 or so, or 200 down. It's now 1,300 and all of that. Price has been going up and down. Now, if you want to give that number to somebody that doesn't really do maths, right? Let's say you aggregate the numbers, you gather everything, and you want to send it out to somebody that doesn't really do maths. How do you present it, right? There are a couple of ways to present it. Obviously, you can use a statistic bar charts, right? And that's where you get these things here, right? You can use a bar chart. You can use columns to represent, right? You can use lines to represent it. But the most famous one that we have come to love and understand is candlesticks, right? All of these things you're seeing here, starting from the bar to the candle, to the halo candle, to the volume candle, to lines with markers, step lines, area, HLC areas, baseline, column, arrows, all of them do the same job, right? But in the high look of things, majority of people have come to understand candlestick. They think they understand candlestick because that's what everybody uses, right? You can use a line chart and you still be profitable. You can use a column and you still be profitable. So let's look at what a column looks like. This is what a column looks like, right? So some people use this. Okay, this also tells a story. This also right here tells a story of the market. Okay, so but then again, we are so used to what? Having a candlestick. So that brings us to what? Candlestick anatomy. So if you understand that candlestick is just a graphical representation of the economy of a country, right? So you get to know what it really does, right? So now for a candlestick, it has 4 parts, just 4. Okay, very, very simple. A candlestick has an opening. So that's basically the baseline where a candlestick normally opens in price. So we have an opening, and then we have a high, a low, and then a close. So 4 lines, and these 4 lines mean something very important. Okay, so you have an opening O, you have a high or a low, so L and H, and then you have a close. Okay, now most people think that the candlesticks are random, right? It doesn't just matter. If people want to teach you about candlestick, they just talk about the size of it, right? They tell you, oh, it's an engulfing, 2 candles together is all of this stuff. Those are equally important, but what's more important is not really the size, is the format at which your candle opened. Okay, so that will bring us to the 4 stuff, the four entries of a candle. Okay, so pay attention. This is going to be very, very important. Like I said, this is not strategy based. Okay, so this is not strategy based, so pay attention. Now, how a candle opens is very, very crucial, right? To how it is going to close. Now, when I say candle, I'm speaking about one space, or just one candle, right? Time frame irrelevant. So you can apply the same notion on a daily, on a weekly, on a monthly, on a yearly, on a 1 hour, on a 4 hours, on a 30 minutes, on a 15 minutes, on 5 minutes, I believe, on 1 minute, on 1 second, if you have the ability to go to 1 second, because I know some people might not, your trading view will not allow you because it's subscription based, right? It's on the premium side. But then people trade 1 second candle, believe me. So time frame a consequence, right? So it doesn't matter. Now, if a candle, now this what I'm about to say is kind of like, let's give it a ranking. I like to do with percentages. So I would say 80% accurate, 80, 85-ish. There are some different scenarios where it doesn't follow the regular suit, but 80% of the time this happens, right? So you can, once you're done watching this video, please, I want you to do something for me. Don't just be somebody that watch my video and feel like you understand it. Watching without practicing is more of you wasting your time, okay? So take out 10 minutes, 20 minutes, 30 minutes. So far your end goal is to be a successful trader. So far your end goal is to be profitable to an extent. Profitability has different versions of it, right? It can be you just making your $200 per week and you're okay with it. It can be making $1 billion per week, right? So it's subjective, yeah? Take time to practice, or even if you don't want to practice, try go back to the chart and see if what this guy says works, right? If there are a few scenarios or few key examples where it works, then that means it's applicable. And if it's applicable, it's something that can help you. Okay, so now 80%, like I said, 80, 85 or so. Whenever a candle is opening, there are specific things that needs to be noted. So let's say we have an opening price here, and remember, a candle only opens where the last candle closed. So the same price that the last candle closed, that's where a fresh candle is going to open. So let's assume the last candle closed here and a new one is going to open. It's going to open, okay, and this becomes the O, which is the opening price of the candle. So this becomes your O, and that's that. So this is your opening price of your candle. Now, if a candlestick, remember, time frame is not of consequence here. If a candlestick is going to be bullish, okay, if a single candlestick, its intention is to go bullish, that's you want go up. Let me use pitching a little bit, although I don't know that some of the people that follow me are not Nigerians, some are from South Africa and the rest, right? But if a candle is going to go up being bullish, right, it is sometimes 80% of the time it is not going to just go straight ahead to being bullish, right? There are different scenarios where it will just go straight ahead and be bullish, right, and just pump up and stop, right? This is when you have something like some certain news, right, or there is already volatility in the market that the market doesn't have time to do the opposing side. So what is the opposing side? If the market is going to be bullish, so let's use this. Okay, so there, it will first of all go down. It will first of all go down. So bullish means it wants to end up. It will first of all go down, and there's a reason for that. Yeah, the reason the market would first of all go down, it's simple. Remember, there are two kind of people in the market. There are buyers and there are sellers, right? So the market will go down to give buyers a discount price. So what do I mean by discount? It's like, when you want to go buy something in the market, yeah, you have you go to a store and you pick up a pair of sneakers and you ask the seller how much. The seller tells you, oh, $5, right? The seller says, oh, it's $5. And you're like, how much lasts? Our mothers do that a lot. The ladies in their house, you guys understand. Some men do it. Right? I mean, the people like us, we don't like to waste money like that. So we ask how much lasts. You see that how much lasts? That's the same situation that applies here. So the market gives you a discount offer, right? So what the market does is very simple. It gives discount offer. So market will first go low, right? And when it goes low, So why would the market stop and then go back up? Market stops and go back up if there are orders. So let's use this line as orders. Let's assume. Please, this line has nothing to do with this candle. It's just drawing, okay? So let's assume that this is an order. This is an existing limit order. You already know what limit orders are: buy limit, sell limit, and the likes of that, right? So if there's an existing limit order and the candle, let's say an existing limit order that was resting on a previous candle's low, right? Market comes in, does what? Goes and tap into it. Now it has activated that order. It has tagged in the buyers that are at that discount level waiting for price. Now what happens? Those buyers that are at this discount level that have been waiting for price to push lower and have tagged them in. So assuming, let's say this is your POI. I believe I don't want to like overstress, but I believe you know what POI is. It's your point of interest, right? I don't want to mention a specific one. So let's just say your point of interest was here and the market opened here. So it will first go low, right? Tag your point of interest in. Now, this is more of a quid pro quo transaction. Now that you've been tagged in, your money will now act as a barrier, or it will now act as a force to push price in that direction, depending on how much is there. All right. So let's say probably, I can't mention numbers, but let's assume that we had over $15 million waiting at this particular level of retail traders, right? And the market comes what? Taps it in. What happens is that it activates price. These orders get called in, and then what happens? The large, I'm trying to put it in a very simplified version because I don't want to believe that all of us are, so I'll put it, even the littlest person here in terms of understanding would grab everything I'm saying here. So market comes in, taps into it, and then does what? The force of the money here pushes price to the other side. So let me remove this here. Now, that is when the market does what we call what? Creates an open, creates a low, and that low will now be represented by the wick that the market left. So this becomes your low. Okay, so here becomes your low. I'm just going to write it down. So open, low, let's use L. So let's use an L to put it up. So low, L-O-W, low. This becomes your low. And then since POI has been triggered, right, and the market has tapped it, what happens? This force pushes price towards to go up and create a high. Now you might be asking, or you might not, because I don't really necessarily think a lot of people would have to ask this, but then market goes up to what? Create a high, right? And what it does is the highest point that this money could have pushed price, that's where it goes, the highest point. And coincidentally, not even coincidentally, it is the mechanism of the market. It will stop at where sellers we are also looking towards short price. So market will push up. Let's assume there was a POI here, something like this, another POI here, but this POI is for sellers, right? Let's just make that assumption. So POI here for sellers. Market goes up, taps into sellers POI, and sellers money gets activated, and then sellers push price back down. So now market has created a high, and that is represented by a wick. Okay, so market creates a low, creates an open, creates a low, taps in people, goes up, creates a high, then tags in premium sellers, right? Premium. So it's basically for sellers. The way discount is for buyers, premium is for sellers, people that sell at high prices, right? So sorry, people that sell at low prices rather. Right. So here, market does what? Taps them in here, and then reduces, but thereby leaving a wick at its trail. TROAIL, right? Market leaves a wick at its trail, and that forms the high of price. So that is how the OHLC happens. This right here, this is the best, simplest definition, without the whole lot of jargon. So market leaves a high. Now, once the market leaves a high, what is left for the market? The market is going to look for a close. What is a close? A close is like a bargaining balanced price, not balance in the sense of balance and imbalance. Like this is where the buyers and sellers agrees that that candle should close. That's the price range. So for like the example that I gave earlier, yeah, where you have your mom and your dad, not your dad, sorry, your mom and a trader arguing for price. Your mom says, "Oh, is it not $1?" The buyer says, "No, it's too low for $1. I'll give it to you for 4.5." The original price was 5 in our example. The mom says, No. This shoe safe. I'm not. My son, my son will just spoil it. No. Let us settle for 3. And the buyer will be like, my profit is less, but okay, let's settle for 3. You see that 3 where the buyer and seller agreed, that is your closing price, right? So here you get your close, and this becomes your closing price. So in turn, this becomes the structure of a candlestick, right? This is for a bullish candlestick anyways, right? Now, I'm not going to go into how this structure comes together. Sorry, how this atomics comes together to form a structure. That might be in the next class or something, but this is basically how a bullish candle is, right? So you have an open, a low, a high, and a close, right? Now, for sellers, you flip it the other way around. So for sellers, I'm just going to quickly do it. We have, okay, so let's say this is the bullish candle, right? So this is where the price last closed. Market opens there. If market is going to be bearish, market will first go up, tagging sellers. Let's say the same POY, you see market tagging sellers and then drop. So we'll have this, we'll have something like this here. I mean, the same sellers, the same POY, right? Market tags it again, drops, then drops on what? This is an open, this is a high, market creates a high, right? So we have a high being created here. This clone, yeah. So here we have a high, clone, we'll have an open here. Market now creates a low, right? Maybe it will now finally go beyond this POI here, creates a low, and then this will be our low clone, and here, and the market then creates a close. Okay, so I will represent the low with a candle wick, obviously. This becomes our low. So this becomes the low, and the market now creates a close. Okay, so see. So that is how a bearish candle works. Okay. Now, I want you to open up your mind and put this into a very deep perspective, right? So you know, now you have an idea how candlestick works. Now, remember, this is 80% of the time. The remaining time, before we even get into that deeper perspective and then we close shop for the day, the remaining time, right, where you see the market do something like this. Let's say this is the high and the low, and then the market ends an indecision candle. Okay, there are times you see this, and then there are times you see the market does something like this with little to no wicks. Okay, so these are situations, these are 3 scenarios that you can see the market do, right? Now, scenario 1 here, when the market does this, whereby it goes in decision, what it means is that what? Remember, the body of a candle, right? Okay, before we even dive into these 2 shapes, because what I'm going to explain here will make here look much more easier. Yeah. So here, these 2 parts play an important role. This body and this wick of a candle. So what does the wick of a candle signifies? A wick of a candle signifies previous price point where market reacted from. Okay, this is the previous price point where market, so it's more like a history. You know, when your mom and the trader is haggling, your trader says 4.5, your mom says $1, trader says 4.5. That $1 and that 4.5 were previous history that they both had a say in, and then they now concluded with $3, right? So that's what the wick is. So it's basically history, price history. So on a week, there is not much volume kind of around there. There is no really much volume. When I say volume, I'm talking about orders, right? There's not much volume there. So those are what wicks stand for, right? And then we have body. Okay, so this is the wick. This is the wicks. Okay, so this is the wick, and then we have the body. The body is the most important part. That is where the volume lives. Okay, that is the major volume, right? That's why you're gonna see some traders, they like to use wicks for entry. Some use bodies for entry. Both of them are equally important, but you need to segregate and know what they do, right? So for a body, this is where the candle, the orders in the market actually do exist. So you have a body range. So you have your open and your close. Within this open and close, that's where a whole lot of volume resided in. Okay, and that's where the volume will keep staying till either it gets mitigated or continued, right? So that brings us to this place. Now, when you see a candle that has a very big wick and little to no body, what does that tell you? Because now we've come to the conclusion that the body is volume and the wicks is history, right? It tells you that what price tested histories. It tested history. When I say price, I'm talking about the market. I'm talking about the candlestick. Okay, price tested the market history, but had volume, had zero volume or low, very low what volume. Now, most people call this indecision candles. Why is it indecision? It's because the buyers and the sellers could not decide on price. Right? They couldn't decide on a specific price point where they both could settle for that economy or product or whatever. So they end up leaving zero room. So whenever I see an indecision on the traditional sense, what you're looking for is if there's an indecision, especially around specific key areas, let's say close to your POI, close to your POI or so, or close to a support or resistance or whatnot, you tend to say, oh, that means that what the volume is fading out. Now, this can mean two things. One, either the buyer and the sellers couldn't agree on price, or two, they agree on price or they agree on a particular direction. These are the two things they could mean. Okay, so either they could not agree on price or they have agreed on a direction, who is going to be taking the next candle. And when I say agree, it's a simple exchange in. This is like I'm going into money exchange, but volume exchange rather. This is like this POI, right? These people, sellers, or these buyers have larger volume than the sellers, right? Or the economy is supporting the buyers and the sellers, right? That's when one dominates the other, right? And then you have an imbalanced market. When you have a balanced market, both of them are agreeing in price. That's when you get consolidation and all of that. But let's not push into that. That's basically what indecision does. And then when you have something as big as this, right, the big bullish or bearish candle, well, let's make a little joke out of that. Yeah. So when you have the big bone, right, the big dog. So when you have something like this, what does it mean? It means that price had little or no time to haggle price. Okay, there was little to no time to haggle histories, right? So it was just big volume. So it means that the color of the candle means that those people dominated that price. Within that price range, you know that there are prices on this side, right? If I'm moving this cursor, you can see the prices here. Yeah, so it means that what, though the buyers, if this is a blue candle, then the buyers totally dominated from here to here. There was no space, and this literally happens when you have influence of micro. Macro. When I say macro, I'm talking about fundamental news, economical factors, and all of that. When you get that big pump, boom, to the top side or to the downside, right? Market open sessions, these are part of the things that can push price. So that's, if the market is not doing this, it's either doing this or this, right? So that's basically how the open and close work. Now, let me take you a little bit. Let's deep dive. Let's scuba dive to the bottom side of the things. Yeah. So let's take, for example, if you now understand this concept, right? And let's say you're a day trader, you just maybe you trade on the 5 minutes, right? And you want to scalp. It becomes easier when, especially when you see where the market opened, right? So in a structural sense, I'm not supposed to talk about structures, but let me highlight what this looks like in a structural sense, okay? Because I know a whole lot of us deal with structures. So let's say market opens, okay? And then if it's going to be bullish, market goes low, and then creates a low, and then goes high, creates a high, and then looks for what? A close. So this is basically what it looks like. Now, most people call it accumulation, manipulation, distribution, and all of that. Fancy names, they are all the same thing, right? But every single thing you can think of, every single understanding of the market coins from understanding this, right? This is very, very in-depth, but I don't know how long this class is. I don't want to take too much time. I'm even tired at this point, but so I wanted to do 2 videos, but I think we'll just end up doing one. Yeah. All right. So this is your open price. This is the low. This is going to be a bullish structure. Open, low, high, close. Very simple. So with these, let's assume you're a day trader. You're someone that trades intraday, right? Within 15 minutes, 5 minutes time frame, right? You, with this knowledge, you can now specifically highlight just one single candle and see the structure where it is going, right? Where did the market open? Did it open with a consolidation, or did it open with a big bang, right? Did it open with a big bang to the top or to the down, right? So you can kind of predict where the next candle is going to. For these are for those now that trade in 4 hours, daily and stuff. You can kind of predict where the next candle is going to be going to, and you can also use this to form a bias, a directional bias, right? I kind of use this sometimes, although it's not the necessary item that I use, but I kind of use it at times. Like I said before this class, I said this is a passive knowledge. It's not something that you actively want to check in on every time. It's just something that you look at it, you know it, and it gives you that information. You're like, okay, good, we use this, right? Something like that. So here now, I'm not here to teach you how to catch a trade at the moment. That's not what this class is for. But this is specifically what it looks like when it comes to structures, right? So you can either catch the open. You can either wait for the open. Most times it's preferable you wait for the open to finish, right? You look for the low, you look for the high, and then you either catch the low, or you catch the high, or you catch the close. Either one is fine, right? But sometimes, remember, the candles can be like this. So you might end up not even having a proper close, right? You might end up just having an open, and then it won't have a proper close. Or sometimes it can be this plus sign here, where you have market opens, goes up, goes down, and then it continues ranging, right? This time around, it just consolidates. It doesn't really give you some proper structure like this, right? And sometimes market can just create a candlestick, and then the next candlestick continues bullish, right? Let me see if I can draw something of significance here. Let's delete this. Okay, so let me just give you an example. So let's say this was a bullish candle, okay, bullish. Now the next candle just opens here, boom, does a low, maybe stops somewhere here, or maybe taps into this low here, or this here, or just let's say touch somewhere here, and then does where is this stuff? Okay, and then does a high, and then close around here. So let's say you were trading yesterday here. This is where we call continuous expansion. So practically the market just continues from the last, 2 consecutive bullish candle. Market just continues from the last bullish candle and then pops up like that, right? Well, some other time it's maybe wants to what go close bearish and engulf the last bullish candle, but you get the drill. Now, this can, like I said, this can apply to, it doesn't just apply to, it doesn't just apply to, it doesn't just, sorry about that. It doesn't just apply to just one daily candle. You can use this on the weekly, right? So let me give you an instance on how it goes on the weekly. So for a weekly, Monday becomes the opening of the weekly candle, right? So Monday is most likely to consolidate, most likely, sometimes, most likely to consolidate. Tuesday creates the low or the high, right? So it depends. It can either go low or go high. Tuesday creates the low or the high if there is need for that, right? And then Wednesday starts the if Tuesday created the low, Wednesday, Thursday creates the high, and then Friday 6 a close. That's basically how you use it, right? That's for bullish, a bullish week. Then for a bearish week, open, Tuesday creates a high, Wednesday, Thursday creates a low, and then Friday creates a close. So in a structural sense, it might be something like this. Let's say you were having a lower low. Let's say Friday closed here, right? And let me paint a picture. So something like this. Market has been in a downtrend, right? And then Friday closed there. You see something, Monday do something like this, okay? So like I said, there are so many use cases. Creates an open, consolidates around. Tuesday goes up, taps into that POI that everybody is waiting for. And then Wednesday drops, right? Breaks the lower low. And then maybe Thursday continues further, or Thursday starts closing and Friday does something like this. So you see, when you apply, when you apply this to structure, when you apply this knowledge to structure, it becomes very, very incredible when you can understand how this works and how to like literally apply it to a whole lot of things. It doesn't make you, it makes you more of being a little bit accurate in the know-how. Now, remember, obviously the market, the fundamentals, the macros can affect a candle decision, can affect how a candle turns out, right? So that's something to put in mind there. I discussed this at length within the within my community, which is the Portfolio University. So if you want to grab the course, you can either go for the course, which is $89, or you can go for the one-on-one mentorship, which is $497. Each of them is a one-time fee, and you get to stay with me, not stay with me in my house, please. So you get to relate with me. I get to teach you proper, for a very extensive period of time. I think my mentees from last year are still with me till this year. I keep on still teaching them and all of that stuff. So if that's something that will interest you, you can click the link in the bio, or in case I forget to put the link, because sometimes I do that, you can just go to TPU Trading. That's the name of our website, .com, and you can watch the video there, and then watch the video to like 6 to 7 minutes. It will unlock the rest of the website, or you can just slide it to 7 minutes. It will unlock the rest of the website, and you can gain access to that, right? So the whole purpose of me coming out and doing all of these things is I'm actually sick and tired of seeing a whole lot of bullshit online ever since I just stopped. When it comes to knowledge, right? A whole lot of people are just spewing, things that are not necessary to your growth, right? So I figured it's left for me to try and do the right thing, and it's left for you to actually listen. This is their portfolio. Remember to subscribe, like this video, comment what you think, share this video, right? And I will see you guys maybe next Sunday also. Also, if you want to join the community where I give out my reactional bias, the link is also inside this website. So you can just join the free community and just chill and get my directional bias. Then you can use it, to the full extent of your strategy. One love. See you guys on the next one. Ciao. Avatar signing out.